Good afternoon, and welcome to the NEXTEQ PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to CEO John Jayal. Good afternoon to you, sir.
Good afternoon to everybody. Thanks very much for dialing in to the NEXTEQ PLC first half 2023 results. I'm joined by my CFO, Johan Olivier. So first thing, those of you that have followed the business in the past, I'm really pleased to say that we're announcing these results under our new brand called NEXTEQ. That new brand sets out our stall as a multi-sector engineering company that can supply product to customers and help them in the markets that we focus to outsource non-core parts of their product proposition. NEXTEQ is an AIM-listed business. We have operated in selected markets, and we do that through a combination of a wide range of engineering skills: computer hardware, computer software, display engineering, mechanical engineering expertise, combined with a Far Eastern manufacturing base, which allows us to provide products to the markets where we focus, which allow the customers to be more successful businesses through outsourcing of non-core parts of their proposition. We're innovative and have 22 patents and 28 trademarks and have around 240 employees globally. And when I say globally, it truly is a global business with operations in 7 countries and customers in around 50 countries and around 6 years of average employee tenure. So a very stable workforce within the company. We've historically had a strong track record of growth with 19% CAGR in revenue since flotation in 2013 to full year 22. And in the first half of the year, just to give you an idea of our sector positioning, around 60% of the business or 60% of the revenue is from the strategic gaming sector. Around 6% of the revenue is from the strategic broadcast sector. And then the balance of our revenues come from a number of other industrial markets that we supply product into. To give you a bit of a flavour of where we play, so in Quicksand, which is our brand that we supply into the gaming market, and as I said just now, about 60% of our revenue, what we saw as an opportunity for us to supply bespoke computer platform products, which allow the manufacturers of the slot machines, and you can see an example of such a machine on the right-hand side of the slide, to outsource that computer platform to us. And by outsourcing that computer platform to us, they didn't need to develop it in-house with their own engineering resource. And that meant they could spend all of that engineering effort on game design. And game design is the thing that drives their commercial success. That is what differentiates them. The computer platform is just an enabler. So having done that, what it meant they could do is they could drive a more lean and optimized business for success. And some of our customers are on the left-hand side of the slide that you see at the bottom there, and they have had quite successful businesses as a result of that decision to outsource. The market's very large and it's very global, so most of our customers are overseas. In fact, around 60% of our revenues come from the US. And actually, the total addressable market in gaming with all of the product offerings we have, which include not just the computer platforms, but also full turnkey cabinet solutions, which we incorporate those computers into a full cabinet product. That total addressable market is over $3 billion. Realistically, within that, there are many segments of that market which we can't address or we couldn't address with our current product portfolio. And so that annual addressable market within the current product set is around $310 million. So a big market for us to go after. The product life cycle, so every 3 to 5 years, these cabinets need to be swapped out for a new product. That's because they get a bit long in the tooth and they need to have more performance to drive the latest round of games. Typical ASP for our computer products is around $1,200, and we have around a 23% of the addressable $300 million market on the basis of last year's revenues. Just onto broadcast. So this is our second strategic market. Around 6% of revenues we supply into broadcast, and it's growing fast. In broadcast, we saw a different opportunity, but again, very market centric. So within broadcast, what we saw was the manufacturers of broadcast equipment, the likes of which are installed in production control rooms in places like the BBC. They were looking to increasingly adopt touchscreen technology into their control interfaces. But that was really difficult for them to do because they had no experience of touchscreen architecture, of the computing requirements to drive those touchscreens. And so what we sought to do is to bring out bespoke turnkey control offerings, which they can put on the front of their devices, and allow them to adopt this touchscreen technology without the pain point of designing it all in-house. One of the things we learned in that market was the tactility that they feel from controlling the equipment was so important, because they don't always have line of sight to the control device when they're operating it. So what we then sought to develop, and we've now sought to patent, is tactile touch technology. So objects which sit on the front of the touchscreen surface and allow the manufacturer of that equipment to keep that tactile feel, but also to have the multi-programmability and the multi-purpose ability of a touchscreen. And customers are selected this because it allows them to revolutionize their control interface without having to go through that painful R&D effort. Same kind of way we look at the market. So the total annual addressable market is around $880 million, of which around $220 million is realistically addressable with our current product set. Product life cycle is about 5 to 7 years, and the typical ASP for our products is over $1,000. And on the base of last year's revenue, we had around 3% of the addressable market in the broadcast sector. Final component of the business is Dentster on Display Components. This is a company which we acquired in 2015, and this has a very broad market exposure with over 500 customers that we supply to in different market sectors. Through Dentster on Display Components, we've been able to identify new focus sectors in which we can develop higher value businesses. And that allows us to penetrate up the value chain, also allows us to generate better margins. The Dentster on Display Components market on its own, though, however, is extremely large but very competitive. So $6 billion annual addressable market globally, and around a 5 to 15-year product life cycle. So we have some medical customers, for example, in this sector that we've supplied for over 10 years. And so you can see sort of how sticky that business is. However, it is also very competitive, and therefore the margins that we earn are lesser than we do from broadcast or gaming. Typical ASP is quite small because these tend to be quite small displays that we're supplying, and it's less than 1% of the addressable market that we have with our current product set. What we've built with the business is a scalable platform which allows for organic growth or efficient organic growth within the businesses that we have already, and also a platform for plug and play acquisitions as we go forward. So within NEXTEQ, we have all of the core components required, the engineering capabilities, the supply chain and manufacturing, which we do out of Asia. So we have a Taiwanese-based office that does all of the supply chain, and that means that we get that access to the critical Asian markets. And that was so important over the last 2 years when we've had such an unusual period of time around electronic component shortages. We've also got centralization of all core functions around servicing the business. And then at the market level, we have specific sales, account management and product innovation teams that have the domain knowledge needed to target the gaming market, the broadcast market and other industrial sectors. So that gives us that scalable platform where as we grow, we keep our overheads in check and allow that operational leverage to flow through to enhance profitability. The growth strategy for the business we've deployed already in 2 markets I've just taken you through. So the growth strategies will identify markets where they would benefit from having a specialist outsourced provider. So currently they are trying to do lots of the stuff that they need to do themselves, and some of that stuff is non-differentiating to them. So if we help customers by providing a specialist product, that would benefit those businesses. We then seek to acquire customers in those chosen target sectors and then undertake R&D so that we can penetrate further up the value chain with our product propositions. And where we see opportunity to do so, we'll undertake M&A to accelerate that organic growth. So when we look at that growth strategy, that's exactly what we've applied in gaming. We identified the gaming market as needing a bespoke computer offering. We then sought to acquire customers from doing that. And then because we've done this R&D, we've extended further up the value chain. And I've got a slide in a few slides' time which takes you through a bit more detail about how we've penetrated through that value chain. So some of the highlights of the first half, it's been a strong period of financial performance. We grew our business in both the strategic gaming and broadcast sectors, and this reflects the strength of order book that we had entering the first half of the year. We've also, combined with that strong revenue growth, delivered materially improved profitability with gross margins returning towards historic levels, and that's driven up our operating profit significantly in H1. As many companies have seen, there's been a normalization of order book, and that's been reflective of the shortening supply lead times. And through the last 2 years, we've seen extremely long lead times, some cases sort of 20 to 50 weeks. And now we're getting things back to more normal levels. Customers can order a bit later. And so the order book has come in, and that gives us more typical levels of visibility. We've also been able to make investments to drive our growth strategy that I just outlined. And that's all about diversification of our business into more customers and into more markets. And finally, we've held a net cash position in the business through most of its history. And that net cash position is built up from our strong cash flow generation that we have. And we've continued to build on that in the first half of the year. And with that, I'm going to hand over to Johan, who's going to go through some of the more detailed financial highlights.
Thank you, John. Good afternoon, everyone. This slide just sets out some of the financial highlights for the first half of this year compared to the first half of last year, further to some of the comments that John just made. I'm not going to go through these in detail, but overall, all positive, all trending in the right direction. So a good first half from a financial perspective for the group. Just specifically on group revenues, 56.3 million, so up 6% from 53.3 million in the first half of last year. Beyond just the absolute revenue growth, one of the focus areas for us is around diversification of our revenue. We started out as a gaming business. We're very proud of our gaming heritage, but growing into other sectors is important. And one of the ways that we measure that is around percentage of our revenues from our top 10 customers. That was 52% in the first half of the year, down from 60% in the second half of last year and 54% in the first half of last year. With the new business ones that we've made recently, we expect to drive further revenue diversification and get that percentage down in the medium term. Just looking at our revenues by division, starting with Quicksand on the left, $34.3 million in the first half, up 9%. The graph shows revenues going back to 2018, and for those of you maybe not that familiar with the group, the decline there in 2020, the impact of COVID with casinos closed for a quarter, and then since then we've had a steady improvement in the gaming industry, and this 34.3 million in the first half of the year, a near record high for the Quicksand division for a first half. The growth that we've seen year over year was almost solely volume driven. We put some price rises through to our customers in 2021 and 2022 in response to component price inflation. We've not put any price rises through since then. And so our revenue growth has really been driven by the improvement in our platform sales, up 13% year over year. And then also within that 34 million, we delivered our first turnkey gaming cabinet deliveries. We won our first order last year, and the cabinet is an expansion of our gaming product range and allows us to have a larger addressable market within gaming. Then moving on to Densitron on the right, $22 million in the first half of the year, marginally up on the same period last year. You can see that a trend over the last few years, a more stable revenue profile from Densitron, but we have taken a step up in the last since 2021, 2022, as you can see revenues up compared to where they were pre-pandemic. Part of that growth has been the strategic broadcast business, which grew 10% in the first half of this year compared to the first half of last year, the third year in a row where that business has grown by double digits. Just moving on to our gross margins, 34.2% in the first half of this year. You can see good improvement compared to 2022. Just to give you a bit more background, again, you can see the margins at 34-35% pre-pandemic. Just to explain the graph in a bit more detail, this is the relative contribution between the Quicksand and the Densitron division. So Quicksand at the bottom, Densitron at the top. And the Quicksand division makes margins at a slightly higher rate than the Densitron division. The impact of the lower margins in 2020 was because of that decline in our Quicksand revenues in that year. In 2021, as many other industries saw, there was a shortage of key components, raw materials. Alongside that, there was also inflation of component prices. That impacted our margins in 2021. You can see it going down to 29% in the second half of that year. As I mentioned earlier, we put price rises through to protect our margin, and that's now started flowing through in our P&L. We started seeing that last year, and that's continued into the first half of this year, aiding that improvement in our gross margin. In addition to that, we've also benefited from a much improved Densitron margin performance. The Densitron team has worked over the last year with our customers to improving our sales prices, focusing on higher margin business, also working with our suppliers to reduce our input cost. And that's delivered a step up in Densitron margin performance. That, alongside the growth of the broadcast business, which comes at a higher margin than the rest of the Densitron products, has meant that we've delivered the best ever margin for Densitron since acquisition in 2015. Looking ahead, we expect gross margins to continue that upward trend, getting to and surpassing the margins that we delivered in 2018 and 2019. Just moving on to profit before tax, 5.9 million in the first half of this year, up 70% on the $3.5 million from the first half of 2022. Part of the increase there is just the improved trading, higher sales volumes, the improved gross margins that I've just mentioned, combined adding $2.6 million to overall profits. We benefited from FX in the first half of this year. So within the 5.9 million, we had about $500,000 of FX gains just from normal trading activities. But in the comparative year, we had losses of about $1 million. So the year over year, there's a positive impact of $1.5 million. And then generally, the stronger US dollar is a benefit to us. Most of our sales are in US dollars, with some of our overhead expenses, like here in the UK or in Taiwan, or in other currencies. So with a stronger US dollar, that benefits our bottom line, and added $500,000 when compared to the first half of last year. And then that was offset by increases in our operating expenses. Part of that was around additional headcounts. We've added some headcount over the last year, predominantly in our broadcast team, dedicated engineering and commercial teams. In the past, broadcast was part of the broader Densitron team. We've now got dedicated resources, and we've started to see the positive impact of that as our pipeline is growing within broadcast. And then in addition to that, we've also seen increased marketing and travel costs. Some of that is against what is some of a soft comparator last year, as there were still some COVID restrictions which limited the travel and the marketing activities in the first half of last year. And then also more broadly, there was the impact of inflation on our overhead expenses. Looking ahead to the second half of the year, other than the annualization of the headcount cost for those new hires, we don't expect a significant increase in our controllable operating expenses in the second half of the year. And then just the graph at the bottom left shows our PBT as a percentage of revenue, so 10.5% in the first half of the year, pleasingly above last year and the first half of last year and the second half of last year. Looking across 2018 and 2019, recognize that it's still not at those levels, but it remains a focus for us in the medium term to get the profit margins up to those mid-teen levels. And we believe we can get there through continued gross margin improvement for the factors that I mentioned earlier, as well as in the medium term being able to grow our overall revenue base and benefiting from that operational leverage from a higher revenue base. And then just finally, from my side on cash, net cash of $18.5 million, up 43% on the position at the start of the year. The largest part of that increase was from the good improved trading. We were able to convert our profit into cash with $8.3 million of cash from operations. We had an outflow of working capital of $1.5 million. That was largely due to a decrease in trade payables, just through the normal course of trading, paying down some of the balances at the end of December. Some of the accruals were held at that point. That was offset by a decrease in our debtors. Collections continue to be good, and our debtors continue to be in good health. And alongside that, a small increase in our stock balance. So over the last couple of years, to combat the shortages that we saw in components, we made strategic stock purchases to ensure that we had raw materials available to continue with production and meet our customers' demand. That meant an increase in our stock levels and an outflow of working capital. We've now started working through that strategic stock, and in the first half of the year, our raw materials decreased by about 10% compared to the position they were at the end of December last year. As at the end of June, that was offset by an increase in finished goods. So we had some finished goods at our sales warehouses waiting for delivery in the second half of the year. But we expect that balance to continue to move down. And with that, will bring continued good operating cash flows. Operating cash flow conversion is a key KPI for us. We achieved 113% in the first half of the year. And we are focused on continuing with high operating cash flow conversion so that we're able to convert our profits into cash, and expect that the cash generation that we've seen in the first half will continue through into the medium term. Just to point out, in the second half, in August, we paid a dividend of $2.5 million. That was a 25% increase year on year. Within capital allocation, we haven't changed that. We prioritize a strong balance sheet. For us, that means having sufficient liquidity that allows us to pay a dividend which would increase as we plan to increase our earnings, alongside being able to invest in the business to drive organic and selective acquisitive growth. And with that, I'll hand back to John. Thank you.
Thanks, Johan. So just take you on a little whistle-stop tour of how the company's positioned sector-wise and product-wise on the matrix on the slide in front of you. So if you remember the growth strategy, we seek to identify target markets where we can play. We seek to acquire customers in those target markets. We then seek to undertake R&D to develop better products for those markets than are currently available off the shelf. And then, having built those products, we then go and try and penetrate up the value stack with those higher value products. So that's the sort of the growth strategy. And then from time to time, we may acquire. So if we look at how we're positioned in that context within the sectors that we service, so the strategic gaming sector, we started with a computer product that I talked about. So that box is ticked. We also have HMI solutions. So HMI stands for human machine interface. That's the screens or the control panels which sit between the user and the piece of equipment. So we have button decks and we have monitors which sit as an HMI solution for gaming. We have a software stack in gaming which allows customers to more easily integrate their games to our hardware. And finally, we have the turnkey cabinet solutions which we've recently launched, which means that for customers they can entirely outsource hardware to us and allow them to focus entirely on software development. So if you look at actually that growth strategy within gaming, we've ticked all of the boxes on the parts of the value chain we can target. The only thing really left in that value chain is going up into game design, and that's something we're never going to do because that would be competitive with our customers, and it's something that we're really there to enable them to do the best. So gaming, we have got a fully penetrated product set within that within that space. What we still have plenty of growth to achieve, however, is acquisition of customers to leverage that fully filleted product set and win more business within it. And that's what we're currently very actively targeted at achieving. We go across to broadcast, so second strategic sector that we focus on. We don't do computing in broadcast, and the reason we don't is often the computing for broadcast is done through servers that sit in racks, and there are some very big server vendors out there that is not going to be somebody that we want to compete with. We do have the HMI solutions which incorporate these innovative tactile objects on them, and so we have a tick in that box. We've also got some software that we have built into the business through acquisition of the IDS software platform, and we have turnkey solutions where actually some broadcast companies now look to outsource their whole hardware proposition to us and to focus on doing the software themselves. So within broadcasting gaming, actually our products are pretty well penetrated up the value stack. And these two sectors now, it's all about conversion of customers. So we have got more innovation to be done. We've got more product evolution to be done within both of those, but actually we're already playing in all of those different parts of the value chain. And then in the other sectors in the business that we supply our display components to, Those we supply a component part, we don't supply any of the higher value product to as yet. And where there may be opportunities in the future for expansion into other sectors, that would be about finding sectors in which we find the right characteristics to expand up that value chain. So with that sort of context of those sectors, I'm going to take you through a bit of background around how trading's been. So importantly, in the gaming market, there's been lots of lots of success seen in the US around online gaming, and the US market being 60% of our business. It's an important sector for us. It's an important geography for us. In the US, we're seeing continued very robust gaming demand. So the players are still attending casinos, the footfall's good, and also they're spending significant money in the casinos, and revenues in the US commercial casinos continue to be at historic high levels and have been for the last 5 quarters. In Europe, we saw a much more significant, prolonged decline from the COVID effects, but actually last year those effects were sort of largely behind us. And we saw a recovery from the pandemic back to more normal levels, and that's something which we expect to continue to see. So, sort of right at the end of our gaming value chain, we're seeing the customers, the players attending casinos and spending the same amounts of money as they spent in the past. The next sort of step down is how many machines are our customers able to deploy into casinos. And again, in the same vein, the casinos are buying plenty of machines. So the volumes of demand this year are pretty consistent with where they were last year. The one thing that we have seen, however, is probably the customers were more buoyant about how many were going to be bought this year than actually has transpired. So it's not declined, it's just not quite as much growth as they potentially anticipated. But nonetheless, we've been able to grow our unit volumes by 13% year on year. So there's been growth in our demand, and that's been through delivery of this order book. And that's in the context of perhaps some softer trading from some of the customers, but new business filling that gap and bolstering our revenues. We've also delivered mass production shipments of our first cabinets, as Johan said, and this is a new push up that value stack. And we've got further shipments to go into the second half of the year. Continue to refresh our product portfolio within gaming with new Intel product. That's something where through the last 2 years, while we've been focused on R&D to ensure existing products can be supplied, now we've got more of those efforts being spent on new product design. So we'll have a completely refreshed Intel-based product roadmap by the middle of next year. And our pipeline for new business for both computer solutions and turnkey cabinets is healthy. And we've got a good set of products to be able to deliver on that pipeline. Turning over to broadcast, so the growth you see in broadcast has all been about the ramp of customers, which has delivered another period of double-digit year-on-year growth in the first half. IDS, the software product that I described, is on track to deliver a record year in 2023. And the investments that we've made into the broadcast sales and product teams now with dedication to that sector support the drive and conversion of the sales pipeline. So broadcast all of the ingredients necessary to deliver a decent result in that business. In the other sectors, as Johan alluded to, there has been some softness in demand. So the broader effects of destocking that we've seen across all of the different industries has hit the display component sector in the same way. It's just that our focus on higher margin business and our focus on growth of the higher value gaming and broadcast sectors has meant that's not been replaced with new business, and so there has been that reduction in revenues. However, the profitability of that business is substantially better than it has been in the past. So if I look at, I said earlier that we've been successful in driving value enhancement and diversification through our growth strategy. And within that, here's some sort of progress against each of those steps. So within identification, so we've now just started to identify adjacent markets where perhaps some of our industrial PC capabilities can be deployed. That's because we've got to the point where actually broadcast and gaming, we've got a very well-filled product set, and it's now about the acquisition stage within that. So we're continuing to progress pipeline within that, and we've had orders in early in the second half to deliver against, which mean that we've got customers confirmed from that pipeline within both broadcast and gaming. We've got the Intel-based IQ and Icon gaming platforms which are being developed at the moment, and they'll be launched last part of this year and early part of next year. And we've been successful in migrating customers from the display component sale within broadcast all the way up to a bespoke product offering in that sector. And because we've got this balance sheet strength, and we have a net cash position, we have excellent liquidity, which allows us to identify acquisitions. And perhaps that will be an area where we're able to accelerate the identification of adjacent markets for our industrial PC capability. So in terms of outlook, we're guiding revenues to be broadly in line with the prior year, and that is in the context of a normalization of customer inventory levels. So that is sort of new business replacing business, which is delivering softer demand while that inventory normalizes, combined with us focusing on higher quality revenue business, which is at better margins. And you can really see that flowing through, and that structural enhancement in our operating profit margin for the full year, we expect to persist and to build over time. And that means that we will have a more efficient business that's driving better profitability. Operating cash generation expected to also continue. So whilst last year we did use some of our cash to fund the stock purchases we made, we're now sort of forecasting that to continue to unwind and further enhance our net cash position. So overall, whilst there is this short-term challenge we face around destocking, and that's not dissimilar from many other companies, what many other companies are seeing, we've put in place many of the growth initiatives, and we have a strong balance sheet position, which allows us to deliver strong growth organically, but also importantly through that ability to diversify into other markets through acquisitions. So we believe that journey that we set out at the beginning around NEXTEQ being a multi-sector technology business can be very much achieved by the way the company is positioned today. And that's the end of the presentation. I've got some questions already asked, but if there are any others, I'll be very happy to take them.
John, Johan, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen. While the company take a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. John, Johan, as you can see, we have received a number of questions throughout today's presentation. And if I may hand back to you, kindly ask you to read out the questions, give responses where appropriate to do so, and I'll pick up from you at the end.
Yeah, thanks very much, Alex. So the first question we've got is, should we have NEXTEQ's viewpoint regarding to Q4 business outlook? So yes, so I think so I alluded to it on the slide that's in front of you. So we do expect to see continued normalization of inventory levels, and we've guided to a revenue being broadly in line, and that reflects that broader sort of economic headwind that is out there, and customers destocking to reflect that. What I've also said, however, is whilst there's that sort of whilst there's that short-term adjustment that is underway, actually the long-term structural drivers are very much there for a healthy growth within the business, and importantly, not just a healthy growth, but a more diversified growth within the business. And that's fueled by new business coming in, and once that sort of destocking effect completes, then that new business starts to fuel revenue growth overall within the company, and then also because we have that capacity to acquire as well, which will drive further build on our business. And because we're not in a position where we're indebted already, that there's good borrowing capacity as well should we need to do so. So in terms of Q4 business outlook, the guidance is there. We're expecting to deliver profits that are in line with expectations, and expectations being ahead of where they were in the prior year, and that is on the strength of the operating profit margins that we're seeing, combined with revenues in line with prior year. Second question is the business affected by the Hollywood writers actors strike? And the answer to that is we haven't seen any effect of that so far, and we haven't heard of any effect of that so far. So that's not been an excuse that's been used as yet. What I will say is sort of just in terms of when that would affect us, you'd be looking at that being a lagged effect, because the first thing that would happen would be less production in films. That less production in films would mean that the studios would be making less money, and thereafter you'd see a potentially a slowdown in their capital expenditure. What I would also add, though, is that Hollywood and the film industry is only one of our end markets that the broadcast solutions are deployed into. So, for example, we have broadcast technology going into outside broadcast tracks for sporting events, which is a buoyant market at the moment, for concerts, etc. We also have it going into the broadcast corporations for things like the news networks. So our broadcast end market exposure, where our customers deploy, is sort of far beyond just the sort of the film industry. And in particular Hollywood. Third question we've got, given the lowly rating of the company's own shares, is the board considering whether buybacks or a tender offer would create more value for shareholders and acquisitions? So I think on one of the slides, Johan picked up the sort of the capital allocation priorities we have within the business. So we obviously will always maintain a strong balance sheet, and as an outsourced player, that's incredibly important. It gives our customers confidence that we're going to be here through any economic cycle, and that strong balance sheet is why through the last few years we've weathered it so well. So first of all, we will maintain a strong balance sheet, and we will maintain a degree of cash balance on it to ensure sufficient liquidity. That said, however, we do see quite compelling opportunities on acquisitions to drive growth and diversification. So I think the next thing where we'd look to use cash would be around acquisitions, just because of the nature of what we're seeking to achieve strategically. But buybacks are something which, it's not the first time I've been asked the question about them. Would we be prepared to do it? And I guess if we've got no other use for the cash, then that's something the board has to consider. But at this stage, acquisitions we feel represent a better return on investment for shareholders than doing buybacks. In terms of the next question,
John, why don't I pick up the next question? So the question is, can we expect to see the cash generation continue? And so as we stay on this slide, which shows the first half performance. So over the last, so as you can see, other than our operating cash flow, minimal other cash outflows. We're not very capital intensive. Some of that is capitalization of development efforts, and then for the remainder is just minor maintenance capex. We don't have any debt, so there's no large interest payments. So it really is about being able to generate cash from operations and managing working capital. Over the last couple of years, we've structurally invested in stock, which is why when you look at our cash performance in 2022 and in 2021, it falls below what you've seen in the first half of this year. But in a normal course of trading, we should be able to convert a high percentage of our profits into cash. So on that basis, expect cash generation to be able to continue.
Thanks, Johan. Final question we've got, and if there are any others, please do feel free to ask. So, how much growth do you see in existing markets with potential new customers, and any thoughts for further expansion into new areas? So within existing customers or within the existing markets that we operate, we see substantial growth, double-digit growth within both gaming and within broadcast, and that's because of further penetration of customers within those sectors. The cabinet product we've really only just started to ship, and there's much more growth within that. Within computers, we've got a pipeline of business which is convertible to deliver a sort of a materially bigger business within that. So that's why I can sort of give that confidence. We believe there's double-digit growth potential within our core sectors. In terms of expansion to other areas, so we're looking at some of those now, and we have a very broad sector base through the Denstron business. And right at the front, I showed that one of our biggest sectors within Denstron was medical. We supply component parts to that now, and that's one of the markets amongst many others that we're looking at, whether there are opportunities to develop higher value products for those sectors. So those sort of diversification opportunities outside of gaming and broadcast are likely something which would use acquisitions to accelerate. But certainly, just to be really clear, we see opportunity within our core markets to grow substantially beyond where we are today, which is why we're continuing to invest in those, and where we have a product set which allows us to deliver into that.
John, Johan, that's great. And I think you have addressed all the questions from investors today. So thank you for being so generous with your time. And of course, the company can review all questions submitted today, and we will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which one is particularly important to the company, John, could I please ask you for a few closing comments?
Yeah, we've obviously had a first half where we've delivered revenue growth despite some challenging macro circumstances. That sort of is on the back of a very good year last year and stable trading through what has been a turbulent period. I think the resiliency of the business has been well proven through that. So even in difficult times, we've continued to be profitable and continue to be self-funded through our own balance sheet. And so, that gives us that resiliency. But equally, we're now coming out of that period where some of the dislocations are in place. And whilst short term there continues to be this destocking effect, which we expect to continue into the second half. Longer term, we believe all of the structural drivers to being a more diversified growth business in multi-sectors is very much in place. And that combined with our ability to undertake acquisitions, some of which would be self-funded through our own balance sheet and with the ability to raise debt, should that not be sufficient, we think we're in a very good position for a strong, sustainable structural growth within the company.
John, Johan, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of NEXTEQ PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.